Okay.
Hello, this is Brett Rentmeester, President of WindRock Wealth Management. As we observe investment markets today, perhaps the biggest question is the future of interest rates. We wrote a blog last year suggesting that bond yields could crash lower, and we've seen that decline play out with an estimated 1/3 of European bonds now trading at negative yields. What about the future of U.S. interest rates? To answer this question with some thoughtful analysis, we're pleased to be joined by Dr. A. Gary Shilling. Dr. Shilling is the president of A. Gary Shilling and Company and the editor of A. Gary Shilling's Insight, as well as being a 32-year Forbes magazine columnist. Shilling received his bachelor's degree in physics from Amherst College and his master's degree and doctorate in economics from Stanford. Before establishing his own firm in 1978, Dr. Shilling was chief economist of White, Weld and Company, and earlier had set up the economics department of what is now Merrill Lynch. Gary, thanks for joining us today.
Oh, my pleasure indeed.
Gary, while most economists continue to forecast rising interest rates year after year, you've been steadfast for many years now about predicting that U.S. rates will continue to come down, ultimately expecting the 10-year Treasury to fall to about 1% from its current 2.2% level. Gary, we'd like our listeners to understand your thesis for what could drive U.S. interest rates lower. So please walk us through your thoughts here.
Well, it's really a combination of economic weakness, and I'll go into that on a global basis in a second. It's also the haven of the U.S. dollar, and it's the rising threat of deflation. We're seeing that in Europe and probably spread globally, as opposed to inflation. It's really those characteristics which are at work. Now, if we look at the economic growth environment, and you can see on this slide U.S. GDP during expansions, you can see 2.2% growth in inflation-adjusted GDP. That's a compound growth rate since the recovery started in the middle of 2009. That's clearly, as you can see in this chart, the slowest of any in the post-World War II period. Now, what's going on there? Well, it's really summed up in the title of my most recent book, written in 2010. It was The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. What's going on here is a universal working down of excess debt that was built up in the 80s and 90s in areas like housing and in the banks and the consumer. And that debt on the way up, it financed a lot of spending. As that debt is being worked off, it's resulting in slower economic growth. Now, this is not just the U.S. If you look at the next slide, Japanese real GDP, you can see it's pretty much the same thing in Japan. Very slow growth, and Japan has seen slow growth not just a few years, but really since 1990, when their bubbles in real estate and housing broke. And then you move on to the Eurozone, the next chart, the Eurozone Real GDP. They had a second recession after the Great Recession in 08-09 that everybody had globally. They had another recession 2011 into 2013. A shallow one to be sure, but the growth is barely growing since then. And finally, among major countries, China. Chinese real gross national product. You can see there they were rolling along at double-digit growth. The recession knocked them down, and particularly U.S. consumers who bought an awful lot of Chinese exports, they were in effect striking. So growth dropped down to what for China is a recessionary 6% annual rate. They poured on the coal with economic stimulus, largely bank loans, pushed it back to double digits, but they got inflation and a housing bubble, so they clamped down, and the growth is now back to about 7%. If you can believe the numbers, and I think they're probably overstated, the growth is probably more like 3 or 4%. But you really have a universal situation of slow economic growth. Now, I don't think this is going to change much for a number of years. It normally takes about a decade to work off excess debt, the age of deleveraging. At the rate we're going, it could take even longer. We're 8 years into it, so it could take longer than a couple of years from here on.
And Gary, when you talk about these subpar growth rates, and your forecast of the 10-year Treasury dipping down to 1%. Does your forecast require a global recession to see those levels?
No, not really. Now, there's another recession out there waiting for us in the underbrush somewhere, but I'm not forecasting that. I'm just saying I think we get this continuation of slow, grinding, minimal growth on a global basis, and we're really in an excess supply world. You look at all the investment that was done a decade ago. You look at what happened in Brazil and Australia, where all these miners of aluminum, or bauxite, copper, coal, iron ore, and so on, they thought that China was going to buy all the commodities in sight, so they went into huge investments, take 5 to 10 years to come to fruition. They came to fruition just about the time that global economic growth slowed down. So tremendous excess capacity in almost anything you can mention, and that's what that's a key factor in pushing down prices. Plus the fact to say that the U.S. is a safe haven, so it really is not a explicit recession that I have in mind.
Yeah, but with subpar growth, I guess, and a lot of potential exogenous shocks out there, what are you looking for that would get you more concerned that a global recession is looming? Is there anything in particular?
It would probably be a shock, because recessions normally start when central banks tighten, and they do so, the Fed in particular, when you get into far enough into a cycle that the Fed worries about overheating economy. They start to raise short-term interest rates that they control. They invert the yield curve. In other words, they push short rates above long rates. And when you see that inverted curve, without exception, at least in modern times, that means a recession and a bear market in stocks is in the offing. The Fed now, I think they're more concerned with deflation than inflation. So the other way the recession could start would be some kind of a shock, financial shock. And you can name any one you want. One possibility would, of course, be a blow-up in China. They're trying to get control of their shadow banks. They're trying to deal with transition to a consumer-led economy and away from exports and infrastructure. Their exports, they don't have the demand now with slower growth in Europe and North America. That's a possibility. You can see it blow up in the Middle East, but I think it's going to be some time before the Fed feels certain enough that the economy's on solid footing that they start raising rates with any great zeal. So maybe a shock will beat them to the punch. Yeah.
Okay, great. We can continue on.
Yeah, now in the meanwhile, of course, the central banks have been in there buying securities with both feet. If you look at the slide labeled central bank assets, you can see their balance sheets that have all exploded. The interesting one for current purposes is the second line from the bottom, the European Central Bank. At the end of 2011, beginning of 2012, they lent €1 trillion to their 800 member banks. Well, what those banks did with that money, they turned around and bought their respective sovereign debts. In other words, the Spanish bank bought Spanish bonds, the Italian banks bought Italian bonds. At that point, those bonds were selling on junk bond yields. Nobody else would buy them. So indirectly, through those banks, the ECB was involved in quantitative easing. A lot of that money was paid back, and now, of course, they're back to quantitative easing very explicitly, and they say they're going back to where they were in July of 2012, which means €1 trillion more euros. But you can see all the banks have pushed up their assets. And one of the interesting things about this is, when central banks buy assets, that does not necessarily create all the money that normally takes place in what's called a fractional reserve system, as the money gets lent and relent. If you look at the next slide, required and total reserves of depository institutions, you can see the red line are the total reserves. That's what happens when the Fed buys, say, Treasury securities. Say they buy a Treasury bond from you. You deposit the proceeds in your favorite bank. It clears through the system. It goes into the reserve account of that bank. Well, normally they lend and relend that to the point that $1 of reserves creates $70 of M2 money. But now they're not lending it. They're scared to lend. Their creditworthy borrowers don't need more money. And you can see the bottom line on that chart, required reserves. The difference between the two, about $2.5 billion. is excess reserves. Excuse me, and that money is just sitting there doing nothing right now. The Fed has to serialize that, do something with it when rapid growth resumes, and I think it will when the age of deleveraging is over, because otherwise they're going to that money could the reserves could turn into money and push the economy past full employment into serious inflation. But that's where we are now. Now, if you look at this, excuse me, if you look at this situation of slow growth, and you say what are the effects of this, there are three that I'd like to mention explicitly. One of them is weakness in commodity prices. And if you look at the next slide, what you'll see is that commodity prices corrected for inflation have been declining. This chart goes back to 1774. They've been declining since the mid-1800s. Yeah, you get the spikes of the Civil War, World War I, World War II, the Arab oil embargo in the 70s, but otherwise it's a decline. Shortages just don't last. Human nature beats shortages any time. And the trend of commodities is down. It's down particularly now because of all this investment that I mentioned earlier back a decade ago. And with the excess supply, it is pushing commodities. It is pushing commodities down. Now, the next effect of that, the second thing that results from this slow growth, is that this commodity deflation is not unique. It's really spreading beyond that to deflation in general. The next slide, 20-year Treasury yields and consumer prices, you can see from right after World War II, this chart starts in 1948 to 1980, both Treasury yields and consumer price index year over year were rising, but since roughly 1980, they both have been declining. And now we're at the point where I think they'll decline even further past zero into absolute deflation. But the point is that we are seeing this weakness, and it's really spreading beyond energy prices. If the Organization for Economic Cooperation and Development, 34 nations, the largest countries in the world, if you look at it, 14 of them now see deflation, year-over-year changes, negative changes in the CPI. So I think that's a factor that is going to spread. And the third thing that we're seeing is competitive devaluations. And there, almost every country is devaluing against the dollar. They all want to see more growth than they have domestically. So they say, well, the way we can do that is get a cheaper currency. That makes our exports more attractive to foreigners. It makes imports less attractive to domestic buyers. Of course, everybody doing that, nobody wins. But if you look at the commodity currencies, the Australian, New Zealand, Canadian dollars, they're all declining. If you look at the euro currency, the Japanese yen, they're deliberately being trashed. And then other currencies like the Korean won, the Taiwanese dollar, they're being dumped because they want to keep up in devaluations with Japan and other countries. So it's universal devaluation that's really taking place. So you really have the commodity price weakness. You have the deflation looming and really spreading, and third, you've got the competitive devaluations against the dollar.
And you see the competitive devaluations continuing such that the dollar remains the area of relative strength, at least in this next phase?
Yeah, I think so. And again, the dollar is the ultimate safe haven in the world, and it's the place people go in times of trouble. Also, there's some real incentives to be in the dollar. I mean, for example, most 10-year developed country sovereign debts, the equivalent of our 10-year Treasury note, have lower yields. Well, you say, gee, is a Spanish or an Italian 10-year government security a better piece of paper, a better higher credit than a U.S. Treasury note? I doubt it, but it's selling as though it is. So I think those yield spreads are going to get closed, and it's probably going to be by the dollar, by the U.S. Treasury prices going up, yields going down, rather than the reverse. So that's a key offset of that, and that's one of the key reasons that I'm looking for further rally in Treasury notes and bonds.
Gary, one other question before we move on, because you alluded to Italian bonds, et cetera. I'd like your thoughts on negative interest rates, because, how much further can rates dip below zero, where the average company, consumer, depositor will simply choose to pull money out of the bank as a means of protecting their wealth versus being penalized for it? And do you believe some of this recent crackdown on cash is an attempt to prevent depositors from doing that if we see even deeper negative rates?
Well, you mean a crackdown in sort of in money laundering, that kind of thing?
Well, I'm referring to there's been some reports in Europe of banks not allowing companies to pull out all of their cash. There have been some reports of the big banks not allowing you to store cash in a safety deposit box, but forcing it to be held in a savings or checking at potentially a negative rate. So we're seeing it on the margin. I guess the question is, the thoughts on the negative rates, can we see even deeper negative rates? And if so, what's the likely
we could. There's several reasons for negative rates. One is, and this is the reason that I've owned 30-year treasuries for the last 34 years. Couldn't care less what the yield is as long as it's going down, because when the yield goes down, the price goes up. And if the yield is negative and it gets more negative, the price goes up. It doesn't make any difference where you start.
Sure.
The more negative the yield gets, the higher the price. So that's one reason. A second one is that many banks and other institutions have to own their sovereign debt. They have to own their government paper. That's the requirement. And a third thing is you've got the Bank of Japan and the European Central Bank buying everything in sight. So it suggests that there is going to be a strong demand. So and then finally, if you have, let's say you have a negative half a percentage point return on a 10-year sovereign debt, and that's not uncommon. But if deflation is say 1.5%, then the real return, you subtract the two, is 1%, and that's not bad.
Yeah.
So this is not completely illogical, and I don't think people are going to necessarily run out of that and hold cash instead.
Interesting. Okay, we can skip forward.
Yeah, well, let's go on to this slide. One of my favorites shows survey of professional forecasters, average 12-month forecast for 10-year Treasury yields. This is put together by the Federal Reserve Bank of Philadelphia. And you can see the red line there is the actual 10-year yield. And then the black dashed lines are year after year the forecast made by this consensus that the Philly Fed puts together going out 12 months. And you notice that every year they forecast interest rates rising, and almost every year they've declined. In other words, there's this universal feeling, and the Fed is in the same boat. They all think rates are going to go down, and in fact they are going to go up rather, and they have been declining. I'd say I've been one of the few who feels that way. And finally, if you come to my favorite chart, comparative stock and bond performance, this is probably my all-time favorite, because I participated in this fabulous trade and have ever since 1981 by owning the treasuries in my own accounts, by owning them in the accounts of money we manage for other people, and finally for forecasting what I said back then was going to be the bond rally of a lifetime. What this assumes is that you bought a 25-year zero coupon bond. You roll it over each year to maintain the maturity or the duration, which is the same for a zero coupon bond. And you put $100 in October of 1981, which is a low on yields. The high on yields, a low on price. And you see $100 is now worth $27,101. Now, if you did the same thing for the S&P at its low in July of '82, and on a total return basis, in other words, reinvestment of dividends, that $100 is worth $4,473. In other words, these bonds outperformed the stock market in what's been a very, very strong long rally by 6.5 times. And of course, many people believe that long Treasury bonds are only suitable for little old ladies and orphans. But I got to tell you, it's certainly been a huge winner for me personally and for the accounts that we manage.
Yeah. And like you said, if rates go down to 1%, there's still a big, even if it's a
Yeah, that's
trade.
right. This bond ride of a lifetime would continue. That's
Yeah.
correct. And I
What's
think
your
it'll
view
be on a
once we
30-year
get there?
bond. I think it'll be 2%.
Yeah. What would your view be once we get there? I know it's data dependent, but let's just say something transpires sooner rather than later and we see the U.S. 10-year Treasury in the 1% range.
It depends very much on what happens to inflation, deflation. If
Yeah.
we get to 2%, say on the 30-year Treasury, which is my target, and at that point, let's say deflation is running 1%, that would be a 3% real return. In other words, inflation adjusted. By historic standards, that would be very good. And at that point, you'd probably want to hold them for yield. The appreciation would be over, but on a yield basis, they would be attractive, adjusted for inflation.
And in an inflationary scenario, I mean, if central banks actually are able to achieve what they've stated of trying to create inflation, you'd look at that scenario and probably exit bonds for the next chapter.
You'd want to be long going.
Yeah.
You'd want to be long going because unfortunately it works both ways. As we saw that earlier chart, when you had rising inflation in the earlier post-war period up till 1980, the yields on bonds was going up, so the price was going down. That is not the time to own bonds.
Agreed. Well, Gary, thank you so much for your time today. I didn't know if you had any other final thoughts before we close out.
No, I think we pretty well covered it. The one thing I think people need to keep their eyes on is what's happening to the economy. Do we continue to see this slow growth, which I think is in the cards because of the unwinding of all this leverage? And if that's the case, I think everything pretty well falls from that. Continuing move toward deflation, if not absolute deflation in the U.S. is already there in Europe. Declining commodity prices and the rush for the dollar as a safe haven, and all this I think really benefits Treasury bills, 10-year bills, and longer-term bonds.
Yeah. And Gary, other than reading your column in Forbes, tell our listeners how they can learn more about your economic thoughts.
Well, we publish a monthly newsletter. It's called Insight. I think you mentioned that at the outset. And people could get information on that at our website, www.garyshilling.com. Or they could, we have a toll-free number. It's 1-888-346-7444. 888-346-7444.
Great. Well, thank you again, Gary. Appreciate your time.
My pleasure.